Welcome to the Kapital News. I am your host, Alex Karitis. Today is September 19th, 2019. Thank you so much for joining me. A few stories we're going to talk about is obviously we're going to cover the markets as we do on a daily basis. We're going to continue to discuss this overnight lending within the repo market because we're on a third day here, and it appears that we might continue for a fourth straight day. So we got to pay attention to this like I have been saying over the past couple of days, excuse me, because something is amiss. And we'll get into that a little bit more. A couple political stories. I'm sure many of you are aware that Donald Trump is now under threat from a potential whistleblower who has talked to the IG of the intelligence community, and this is surrounding some issues with Ukraine, and perhaps the president said something over the phone that he should not have said. We also have the elections which took place the other day in Israel, which is in a deadlock. The parties were not able to come together to form any type of coalition, so it appears that it's going to be deadlocked. So we're going to have to stay updated on this because Bibi Netanyahu, the Prime Minister of Israel, has been around for quite a while. It's understood that he's quite the politician. He's quite the operator, knows what he's doing. Clearly, you don't win that many elections and stay in power for that long unless you know a thing or two. But his power is pretty much up for grabs now, and there's discussion that there might even be another election to settle the score. That's how close it was, and both sides are unable to form a government and get together. So we're going to have to stay focused on this. In my opinion and analysis of what I have witnessed over the years with Israel, and particularly with Prime Minister Netanyahu, he likes to flex his muscles. He likes to play the strong man, and, on the other, more like a John Bolton to me than anybody else. And I don't like that at all. Peace and prosperity. We're not going to be doing the fighting for Israel, ally or not. I don't care. If they want to poke the bear, they want to cause their own problems, we should not have to back them up and go to their rescue because they got into their own mess. That's just my personal opinion of it. But we're going to see what happens because this is going to have some big ramifications because Donald Trump likes to say that he is a great ally, the greatest ally of Israel, and I believe that Netanyahu plays this up. There was a recent article that came out in regards to former Secretary of State Rex Tillerson, who was also the former CEO of ExxonMobil, came out and made some comments in regards to how he believed that Prime Minister Netanyahu was able to, quote-unquote, politically play the president and basically just, talk up his ego. He knew how to push the buttons to get Donnie Boy to love him. And I believe that's probably true to some extent. So we're going to have to see how this relationship unfolds and if Netanyahu is able to maintain power because he has a host of issues that he is facing, too, legal issues over in Israel. So we'll keep you posted on that. The S&P was up 6 cents today. The Dow lost 52 points. The NASDAQ was up 5.5 points. The Russell 2000 lost 7. The Dow Jones Transports lost 0.7%, and the New York Stock Exchange was again flat for the day, but slightly in the red, just like it was yesterday. Now, these indexes were pretty much trading in the green all day, but there was a reversal pretty much to the downside across the board to some extent. And this is this the market getting jittery? Because what's going on here? Because the Federal Reserve came to the rescue with another cut. They didn't have to do it, but they did. I mean, the market was pricing it in. Is that what this was? Buy the rumor, sell the fact? Or are we getting closer to those all-time high levels, and every time we've hit them or slightly exceeded them, there's been a reversal. So is it just jitters? Is this a fight against the bulls and bears, which it has been? I mean, who's going to win out? Because we're approaching some significant technical levels. If we can convincingly break through these levels of resistance, then perhaps this bull market can continue if we want to consider this a bull market. Now, depending on the index, we can have our debate, but that's how that's how it's going to be framed in the financial media. Now, if this reverses, is this just going to be another mini correction? Is this just going to be something that continues for a little bit, like we've seen over this summer, this period of consolidation? Is it just going to be a return to that for a little bit? We'll have to wait and see. It's really anybody's guess at this point because there's so much going on. We have oil trading at $58.60 a barrel, so little change from yesterday. Brent, the international metric, is at $64.80, so a little bit of a gain for both of them in today's trading session. Gold is currently trading at $1,507 an ounce, and silver is at $17.87 an ounce. The U.S. 10-year Treasury is relatively flat, still yielding 1.78%, and the VIX is also flat and is trading at 14.05. So I just think the market doesn't know which way to go. I think it's waiting for more headlines, and there aren't a lot of headlines that are saying that things are fantastic to spur another rally. Unless somebody knows something's going to come out of the, left field or right field to spur this. If it's going to be another trade headline, because we do have the Chinese delegation here in the United States. Those talks did start today. They are to continue throughout tomorrow, and it's my understanding that the delegation, which I believe consists of 30 Chinese, are going to be staying in the U.S. over the weekend, and they're going to be traveling across the country to a few agricultural facilities, a couple farms, I believe. So I don't know if this is just a gesture of goodwill or if there's more to it. Again, are they offering peace with an open hand and then a clenched fist behind in the other? We don't know, but I wouldn't be surprised. I'm very skeptical of any deal, especially at this point, because we're in the midst of the 2020 presidential campaign, and, the president and his team have to be aware that, is this a Trojan horse from the Chinese? Can they, you sign a deal and then boom, a couple months before election, we're not going to keep up to the terms. They're going to, say something out in the media, the Chinese against the U.S., saying that we're not holding up our end of the bargain, or we don't like something, this, that, or the other. Is that a risk the president wants to risk? Because the Democratic candidate, whoever he or she may be, is going to feed on that. The country's going to say, well, this guy can't close the deal. We're going to have 4 more years of chaos. We can't have this back and forth. We just can't do it. We're going to give somebody else a try. I mean, this is a big risk. It's a big risk. Does he want to lay this on the line there? Because he is hanging his hat on his ability to make deals, which he has not done too many of those. And the ones that he have increased the debt ceiling. So we have trillion-dollar deficits again. Thank you very much, Mr. President. And, where's this going to continue? The economy's hanging his hat on the economy and on the stock market. So everybody's on pins and needles here. So the president has to be careful here, as far as I'm concerned, but we'll see what happens. We have FedEx, which is trading actually slightly below where it was back in December of 2018, if you can believe that, folks. Of course, they sold off 13% yesterday, but they did regain 1 percentage point in today's trading session. U.S. Steel shed 11% for the day. 11%. That's U.S. Steel. We've been talking about them, and we said yesterday, we've been covering that story here for quite a while, and we came across an article on CNN. So everybody's starting to catch up to this. What's going on? Not as strong as everything is, because we are not an island unto ourselves, because we have U.S. Steel pointing the finger, domestically, but more so abroad. A lot of issues in Europe that are continuing, despite the fact that the ECB is cutting interest rates even deeper into negative territory, and despite that they are restarting QE, 20 billion euros per month indefinitely. So to the repo rates, and the prime thing that we're going to be talking about here for the rest of the podcast is going to have to deal with the Cass Freight Index. The Cass Freight Index, and this is in line with the Dow theory, transportation, and all that jazz, which is why we talk about the Dow Jones Transportations here on a daily basis. So we're going to get to that report here shortly. But the repo rate, okay, again, this is not quantitative easing. And from what I can tell, the financial mainstream media is doing a good job at covering this and making this known. And that's true. This is not quantitative easing. This is not an expansion of the Federal Reserve's balance sheet. Okay, that will happen again. They will go back to QE, and now you have some people out there saying, well, we might go back to QE light. I don't know what that means. That's not going to pack a big enough punch. Believe me when I tell you. It might give a short jolt to something, but that's going to be it. You've looked at the graphs. They're on the capitalnews.com. Our video, our central bank's trapped. You can see the graphs for yourself. They are going to have to print so much money if they're going to stay continuing to do this and to play the markets. If they want to own these markets, which they're clearly doing, they're going to have to print so much money and inject so much liquidity, it's going to make your head spin. It's not even going to be funny. It's going to be disgusting. But that's what they're going to do, because they're not going to come out and admit to us that they've made a mistake, that this monetary experiment has not worked. It is not working. and it's pretty much doomed to failure. They're not going to come out and predict recession, despite the fact that the New York Federal Reserve's own website will tell you that the probability of a recession is at 40% for next year, and anytime that number crosses 30%, it's 100%. 100% every time that happens, and that's on the yield curve, and we have a video on the capitalnews.com that covers just that as well. So anytime the Federal Reserve's recession forecast, okay, that is predicated on the yield curve between the 10-year Treasury note and the 3-month Treasury bill, projects a probability 1 year out of 30% or greater. Every time this has happened going back since 1959, and all those recessions in between that period, a recession has ensued. So you can go out there and you can say this time's different, and that's fine. But like I said here multiple times on this podcast, when you hear that language, this time is different, run for the hills and be careful. But feel free to think that way. So the repo rate, overnight lending, it's starting to seize up. Why is it starting to seize up? We have over $1 trillion in excess reserves out there. So is there a consolidation of these reserves and only a few institutions that don't want to let it go? Are they hoarding this cash? And if they are hoarding it, which they evidently are, why are they doing it? Is there something else beneath the surface here? Because, you're talking about hundreds of billions of dollars in quantitative easing over the course of QE1, QE2, QE3 that spanned almost a decade, right? You have tens of billions of dollars on an overnight basis, 50 billion, 70 billion, 75 billion. We're over $200 billion over the course of a few days, all right? When we were doing just the quantitative tightening, so the opposite of quantitative easing, quantitative tightening in pulling liquidity out of the system, all right, which the Federal Reserve just stopped in July of this year, and what the president has been complaining about, that they're too tight, that they started quantitative easing, they shouldn't have done it, this, that, and the other. We cover that here all the time. That was $50 billion a month that the Federal Reserve was pulling out of the system. All right, $50 billion a month. They're doing that on a nightly basis, putting it back into the system on a nightly basis. So something's amiss. We're not going to know who it is. The only way we'll ever find out who this is if there's a whistleblower, if there is some sort of audit where this comes out, which that most likely will not happen, or we got to use our street smart skills and look to see what happens maybe a month from now or a couple months from now to see who goes out of business or who's really struggling. Oh, well, that makes sense now. They were probably the ones who couldn't get funding overnight a couple months ago in the repo market. That's how you're going to have to start thinking about things, because they're not going to come out and tell you who it is. All right, this is the same thing that I spoke about yesterday when Senator Bernie Sanders challenged the former Federal Reserve Chairman Ben Bernanke, saying, what did you do with all that money? Who did it go to? You gave trillions of dollars to U.S. corporations, U.S. banks, and even we understand international corporations. Where'd the money go? I'm not telling you. So they're not going to tell us where this money's going because they don't want to cause quote-unquote panic. This is the system, folks. This is everything on trust and confidence. Trust and confidence. We have to trust a bunch of criminals who bail each other out. Privatized gains, socialized losses. This is who we place our trust in every single day. Every single day. And it's ridiculous to me, but that's what it is. And like I said, I've come across reports where it's projected that this is going to take place for the fourth night in a row. So we'll keep you posted to see what happens there. But this is something to be mindful of, because we have not seen this type of surge in interest rates on an overnight basis since before the Great Recession. So again, something to be mindful of. Now, on to the Cass Freight Index. That's Cass, C-A-S-S. You can find this online. This is periodically spoken about on the financial media. And again, this is in agreement with what we believe here at the Capital News, that freight is a leading indicator. We believe in the Dow theory. That's why we talk about the Dow Jones Transports here on a daily basis. That's why we're focused on FedEx. And that's why we also look from time to time at the Cass Freight Index report, which comes out on a monthly basis. So they just produced their August report. And here's what we have. The economic outlook. Now, it's just to kickstart this here. This is a 30-page report. I'm clearly not going to read the whole thing to you, but we're going to focus on a couple things that have been in agreement with what we've been saying here, but from their perspective, because they do a lot of research in the freight industry. So the economic outlook from freight's perspective, dropping another 3% in August. Negative volume 9 months in a row. More signs of contraction. When will the GDP turn negative? Continued deterioration in the cash freight shipments index concerns us. When the December 2018 cash shipments index was negative for the first time in 24 months, we dismissed the decline as reflective of a tough comparison. In January and February of 2019, we again made rationalizations. When March was also negative at negative 1%, we warned that we were preparing to change tack in our outlook. When April was down negative 3.2%, we said we see material and growing downside risk to the economic outlook. With a negative 3% drop in August, following the negative 5.9% drop in July, negative 5.3% drop in June, and the negative 6% drop in May, we repeat our message from the last 3 months. The shipments index has gone from warning of a potential slowdown to signaling an economic contraction. So going from a warning of a potential slowdown to signaling an economic contraction within their data. We acknowledge that all of these negative percentages are against extremely tough comparisons, and the cash shipments index has gone negative before without being followed by a negative GDP. However, weakness in demand is being seen across most modes of transportation, both domestically and internationally, with many experiencing increases in the rates of decline. We know that freight flows are a leading indicator, so by definition, there is a lag between what they are predicting and when the outcome is reported. Nevertheless, we see a growing risk that GDP will go negative by year's end. Now, just yesterday, folks, when we had the Federal Reserve chairman out there saying, well, look, everything's just fine and dandy. We're doing this 25 basis point cut as another insurance against a lot of headwinds that exist out there, a lot of geopolitical risks, the trade war, et cetera, et cetera. But they said that GDP for this year was going to be 2.2% in 2019 and 2% in 2020. Now, we said there's no way, especially not on the 2020 figure. I'm very doubtful of the 2019 figure as well. But that's what they're saying. So again, you're not going to have the Federal Reserve come out and ever predict that there's going to be a recession. It's just not what they do. It causes too much mayhem and pandemonium, even though that would be leadership, even though that would be the truth from time to time. Because again, recessions aren't outlawed. They're going to happen. It's part of the business cycle. But they're not going to come out and do this. So you have the Federal Reserve saying growth continues, 2.2% for 2019, all positive. We have the cash freight index saying, look, we're anticipating, given freight, GDP will go negative by year's end. Continuing, the weakness in spot market pricing for many transportation services, especially in trucking, is consistent with the negative cash shipment index, and along with air freight and railroad volume data, strengthens our concerns about the economy and the risk of ongoing trade policy disputes. Weakness in commodity prices and the ongoing decline in interest rates have all joined the chorus of signals calling for an economic contraction. The report continues. It has various graphs. I advise, take the time to Google it. Again, Cass Freight Index, CASS, and you can find this. Again, it's a 30-page report, but we're going to continue with a little bit more here. We should note that the Cass Freight Index was one of the first freight flow indicators to turn positive in October of 2016. Now, you have to remember, folks, 2015, 2016 was that mini manufacturing recession, and there was a lot of calls that maybe we were going to go into recession back then, but you still had quantitative easing taking place. You still had an aggressive Federal Reserve. We were still at low interest rates. There was still a lot of push behind that, but there was that mini recession in the manufacturing sector. But this is just coinciding with that, that's saying, look, even when that was the case, the freight index showed that we were coming out of it. Again, confirming that it's a strong leading indicator. As we try to navigate the ebb and flow of the economy, we don't pretend to have any secret sauce or incredibly complex models that have exhaustively analyzed every data point available. And again, simplicity is key. We talk about that here all the time. Our volatility model, which continues to accurately predict what we are likely to see through the remainder of this year. Buckle up. The volatility we are anticipating is going to be rather sharp for the rest of this year. And that has been proven, and it has been consistent with what we have been saying since we started this podcast, because we've cited our volatility model time and time again. And we also talk about things being simple in our book, The Cynic's Guide to Investing. KISS, K-I-S-S. Keep it simple, stupid. We can build complex models, and I do that from time to time. And it's interesting and it's fascinating to see how those things work. But it's always the simplest or the most simple of models that always fascinate me the most, because they tend to work the best. And so, don't outfox yourself, don't outclever yourself. Just put these economic puzzle pieces together one by one, layer by layer, and see what type of picture is being painted. So I like the fact that they call out that this is not incredibly complex. It's just basic, right? Continuing, instead, we place our trust in the simple notion that the movement of tangible goods is the heartbeat of the economy, and that tracking the volume and velocity of those goods has proven to be one of the most reliable methods of predicting change because of the adequate amount of forewarning that exists. Beyond our concern that the cash freight shipments index is negative on a year-over-year basis for the 9th month in a row, they note, we are concerned about the increasingly severe declines in international air freight volumes, especially in Asia, and the ongoing swoon in railroad volumes, especially in auto and building materials. We see the weakness in spot market pricing for transportation services, especially in trucking, as consistent with and a confirmation of the negative trend in the cash shipments index. As volumes of chemical shipments have lost momentum, our concerns of the global slowdown spreading to the U.S. and the trade dispute reaching a point of no return from an economic perspective grow. Bottom line, more and more data are indicating that this is the beginning of an economic contraction. If a contraction occurs, then the cash shipments index will be one of the first early indicators once again. So check it out, folks. Cash Freight Index Report, CASS. You can Google it. You'll find it with no problem. This is why we talk about it. Now, could they be wrong? Sure, they could be wrong, but that's going to be another one of these leading indicators that this time is going to be different. Could this time be different? Sure, anything's possible, but we're not just talking about possibilities. We're trying to, supply and talk about probabilities. And the probability of this time being different with the yield curve inverting on the 10-year and the 3-month and on the 10-year and the 2-year, with PMI data showing contraction, ISM data showing contraction when it comes to manufacturing services, is still in expansion mode. When you have the Dow Jones Transports leading lower, when you have FedEx leading lower, when you have, again, U.S. Steel showing weakness, forward guidance coming down, when you have small caps still to the downside, still in correction territory. Now, of course, they've had their rally over the past couple of weeks. Will that continue? That's another serious question, because a lot of those companies are heavily indebted. A third of the Russell 2000 is not profitable. So you're really going to have to light a fire under their asses to get this thing to rally, or there's just going to have to be so much liquidity that's thrown into the system to keep that rally going. And I just don't think that that is fundamentally sound. Now, we're attempting to apply logic to an irrational market. So, the market can remain irrational longer than any one of us can remain solvent. So that's always something you have to be aware of. That's why I always say stay diversified, because you never know what's going to happen. The markets are bigger than all of us. The Federal Reserve has a printing press. They can print money and they direct where things go. Does it always happen? No, it doesn't. And that's why you have the breaks. That's why you have the business cycle hit the peak expansion and go into recession. If the Federal Reserve always got its way and always just wanted to keep the expansion going, good luck, but they don't do it. Or they're the cause of the recession, which they are. I mean, this is why we also talk about ending the Federal Reserve. They create the boom, they create the bust. Get rid of them. We don't need them. We don't need them. There's no central committee telling you what the price of oil is. There's no central committee telling you what the price of soybeans is. There's no committee telling you what the price of lumber should be. Orange juice, pork bellies. The market does it. You don't need a bunch of eggheads sitting around a table telling you what the price of capital is supposed to be. Period. End of story. You don't need it. So get out of that zombie-like state. Don't just accept that they've been here for 100 years and that's the way it is. That's the way it's got to be. No, it doesn't. It doesn't have to be like that. We got to get rid of them. So pay attention to these forward-leading indicators. Continue to pay attention to the financials, which are also leading lower. And now with this liquidity crunch that we have witnessed over the past 3 evenings, will it continue for a fourth? Probably. The same excuse that it's corporate taxes and U.S. Treasuries coming due, how long are they going to run that excuse? It's going to run out of room and run out of runway here pretty soon as far as I'm concerned. I'm already highly skeptical of them, but I'll let it play out for a little bit and we'll see what happens. So stay tuned to a lot of this. We got the political news again with the president and the whistleblower. We have the Israeli elections. Will there be a third one? We still have Brexit nonsense that is continuing. We still have the Hong Kong protests. And we are in the midst of the 2020 presidential election. We are not short of news. Stay diversified, stay vigilant, and stay with the Kapital News. Thank you so much, ladies and gentlemen. You'll catch me here tomorrow. This is the Kapital News. I am Alex Karitis. Godspeed.